It is January 24th, 2026, and Bitcoin is trading in this incredibly tight, almost suffocating range between, what, 92 and $95,000. And I have to say, just looking at the screens this morning, the silence in the market is, it's getting really loud.
It's eerie, isn't it?
Uh,
It's that classic calm before the storm vibe. But the problem is, nobody knows if the storm is going to blow the roof off
yeah.
or flood the basement.
That is the perfect way to describe it. It feels like a standoff. And if you're an active trader, this is the most dangerous kind of market because the chop will just kill you before the trends even start.
Exactly. Liquidity is drying up, leverage is resetting, and everyone is just sort of waiting for someone else to make the first move.
So that brings us to the mission for this deep dive. We are going to try and cut through all the noise of the last few weeks. We're looking at a huge stack of sources today. We've got on-chain analysis from Glassnode and Amber Data, institutional reports from Bernstein and Standard Chartered, and we're even digging into some raw sentiment from trader forums just to see where the retail head is at.
And the goal, really, is to answer that multi-trillion-dollar question. Is this distribution, did we actually hit the cycle top back in late 2025 and we're just in denial? Or is this a massive reaccumulation phase before a rip to, say, 150,000?
Right. And we're going to talk about exchange reserves hitting levels we haven't seen in nearly a decade.
A huge one.
A massive structural shift in how institutions are using the ETFs, and a very, very specific signal from a whale that triggered at exactly $89,193.
And that specific price point, it's going to be crucial when we build out our scenarios later on.
Let's get into it. Let's start with the technical setup, because to the casual observer, Bitcoin looks like it's doing absolutely nothing, just chopping sideways. But you flagged something in the token metrics analysis about the Bollinger Bands.
Right. In technical analysis, boring is usually where the violence incubates. We are trading in a range, roughly between 90 and 96,000. But if you look at the Bollinger Bands, they're compressed to a level we just haven't seen since July of 2025.
And we all know what happened after July 2025.
Massive expansion. For the traders listening, you know the drill. A squeeze like this. It represents energy storage. It's a coiled spring. The market is being compressed between buyers and sellers, and the standard deviation is just getting crushed. Historically, when volatility gets this low, it is mathematically impossible for it to stay there. It always precedes a massive, high-velocity move.
But the squeeze itself doesn't tell you the direction, right? It just tells you the explosion is imminent.
Precisely. It's kinetic energy just waiting for a vector. We are sitting on a powder keg.
Okay, so if we're sitting on a powder keg, we need to know where the fuse is. Looking at the daily pivot points in the sources, where are the lines in the sand?
On the upside, the magic number is $98,300.
And that's the short-term holder cost basis, correct?
It is, and we should talk about why that metric matters so much right now. It represents the average price that recent entrance people who bought in the last 155 days paid for their coins. Right now, with the price in the low 90s, those people are underwater. They're feeling pain. So when price pushes up to 98,000, their natural instinct is to sell.
To get out at break even.
Get me out at break even, yeah.
So it creates this big wall of overhead supply, resistance born of anxiety.
Exactly. But, and this is the key for the bulls, if we break above 98,300, suddenly all those holders are back in profit. The anxiety just vanishes, greed kicks in, and they stop selling. That is usually the trigger for momentum to really accelerate.
So that's the ceiling we need to shatter. Now let's talk about the floor. Because I saw a data point in the Amber Data report about that 89,000 level, the whale signal.
Oh, this was fascinating to watch in real time. There was a major whale entity holding a pretty significant short position. They were betting on the price dropping. But on January 23rd, they closed an $18.58 million short position.
That's a decent-sized clip to close out.
It is. But look at the price they closed it at, $89,193.
Wow, that is incredibly precise.
It tells you something about the order books.
Yeah.
It tells us that smart money has identified that level as the hard floor. They were essentially saying, I don't think it's going lower than this. I'm taking my profit and getting out of the way.
Yeah.
When you see shorts de-risking at a specific level like that, it acts as a soft support. It's a huge psychological boost for the bulls because it implies the bears are scared of that level too.
So 89,000 is where the whales are drawing their line. That helps define our risk. But I want to zoom out from the price action for a second and look at the plumbing. the supply dynamics. Because one of the headlines that really jumped out at me from the Glassnode report was about exchange reserves hitting multi-year lows.
This is, I would argue, the most bullish fundamental factor we have right now. If you just ignore the price action and look at the inventory, the story is incredibly positive.
Okay, so break down the numbers for us. How low are we talking?
Well, the amount of Bitcoin sitting on centralized exchanges, Coinbase, Binance, Kraken, it's dropped to between 2.4 and 2.8 million BTC. We have not seen levels this low since 2018.
That's a massive drain. So the coins are physically leaving the store.
They are flying off the shelves, and we can track exactly where they're going. There are three main sinks absorbing this supply. First, obviously the spot ETFs. Even with all the chop we've seen lately, BlackRock's IBIT and Fidelity's FDTC are still acting like vacuums.
And then you have the corporate side.
Right. Corporate treasuries. You've still got MicroStrategy, they call it strategy in the report, holding over 670,000 Bitcoin. I mean, that is an insane amount of corn for just one entity to remove from circulation.
Okay. And the third sink.
Cold storage. Old school HO dealing. About 74% of all Bitcoin is now classified as illiquid supply.
Right.
That just means it hasn't moved in 2 years or more. It's locked away in deep freeze.
So if 74% is locked up and exchanges are at 2018 levels, the float that's available for trading must be incredibly thin.
Thinner than people realize. And this is where the Amber Data report highlighted a shift that I think is the most critical takeaway for this deep dive. It's about how the institutions are using those ETFs.
You're talking about the shift away from the basis trade.
Yes, this is huge. For the last year or so, a huge chunk of those ETF inflows weren't really bullish bets in the way we think of them. It was arbitrage. Hedge funds were buying the ETF and shorting the futures just to capture the spread.
The cash and carry trade.
Exactly. It's market neutral. It doesn't push the price up long term because for every buy, there's a corresponding short. It creates volume, but not upward pressure. It actually acts as a dampener on volatility.
It's basically a mute button on the price action.
Right. But recently, the data shows that trade is unwinding. The basis, the profit margin between spot and futures, has compressed. It's not as profitable anymore. So what we are seeing now is a shift toward directional betting.
Meaning they're actually just buying it because they think the price is going up.
Exactly. They're taking off the hedges. They are going net long. That removes the dampener. And if that trend continues, and you combine it with the illiquid supply we just talked about, the supply squeeze could get very violent very quickly. You don't have the shorts suppressing the rally anymore.
That is a huge structural change. So the fundamentals, the supply and demand mechanics, they actually look fantastic. The engine is primed.
The engine is perfect.
But, and here's the big but, why does it feel like everyone is so anxious? I was reading through the Reddit threads in our source stack, and man, the cycle top anxiety is palpable. It's real fear.
It's PTSD. I mean, you have a generation of traders who were scarred by 2018, scarred by 2022. They are terrified of being the bag holder. There's a thread we looked at talking about cycle top indicators. Apparently, these analysts built over 30 different custom indicators to predict when the top is in. Pi cycle top, MVRV, Z-score, all the classics.
And what are they saying?
That's the problem. Since 2021, 0 of them have triggered. Not one.
That's just confusing.
It creates a dilemma, right? The Reddit crowd is split into two camps. Camp A says the indicators are broken. This time is different because of the ETFs. The market structure has changed, so the old signals don't work.
Mm-hmm.
And Camp B says the indicators work fine. The top just isn't in yet.
But there is a third camp, isn't there? The left-translated cycle theory. I saw this pop up a few times.
Yes. This is the bearish counterargument. The theory is that usually Bitcoin peaks late in the 4-year cycle. That's right-side translation. But because we hit a new all-time high so early before the halving, some argue we left-translated, that we peaked early.
So they think the top is actually back in October 2025.
Right. They think the party is already over and we're just lingering in the lobby. And frankly, looking at gold doesn't help the mood.
Oh, the gold divergence. That hurts to look at.
It really does. Gold is just tearing it up, hitting fresh all-time highs, surging toward targets like $4,900. Some sources we saw even mention long-term targets as high as $23,000.
And meanwhile, Bitcoin is down 30% from its peak.
Exactly. And historically, Bitcoin is supposed to be the faster horse, gold 2.0, right? When it lags behind gold this badly, people get nervous. They start asking, is the narrative broken? Why is the safe haven working, but the digital safe haven isn't?
And then just to add fuel to the fire, we had that Satoshi era wallet wake up, talk about a ghost story.
The dormant whale. Always spooky.
Yeah, a wallet that hadn't moved in 12 years suddenly moves 909 Bitcoin. That's worth what, $84 million? dollars?
Roughly, yeah. And instantly, retail Twitter just goes into meltdown. Oh no, the OGs are dumping. Satoshi is selling.
But the institutional reaction was different.
Completely different. They largely ignored it. And this is a sign of market maturity. The market absorbed that $84 million of liquidity without even blinking. I mean, 100 million sounds like a lot to us, but to the ETF complex, that's a Tuesday morning before coffee.
So, despite the ghosts and the gold envy the market is holding, if we assume the top isn't in, where are we going? What are the experts projecting for the rest of 2026?
Well, the consensus among the big institutional players is actually surprisingly aligned. You have Standard Chartered and Bernstein both converging on a target of $150,000 by the end of 2026.
That's a decent run from 92,000. That's a, what, roughly a 60% move?
It is. Tiger Research is a bit more specific. Their valuation model spits out $185,500.
And then, of course, you have Tom Lee. You can't do a price target segment without Tom Lee. What does he know that we don't?
Laughs, Tom Lee, and Fundstrat are always the mega bulls. They are looking at $250,000 to $400,000.
Is that just pure optimism, or is there a model behind that?
No, there is a model. Their thesis is based on market cap parity with gold. Their view is that Bitcoin is just cannibalizing gold's monetary premium. If Bitcoin captures even a moderate percentage of gold's total market cap, especially with gold surging like it is, the math gets you to those numbers pretty easily. It's not magic, it's just market share.
But I did notice Standard Chartered walked back one of their predictions.
They did, yeah. They had that massive $500,000 prediction floating around for a while. They've now pushed that timeline back to 2030.
Why the delay?
They cited a slowdown in digital asset treasury accumulation. Basically, they thought every company in the S&P 500 would be copying the MicroStrategy playbook by now. That hasn't happened yet. So the supercycle might be delayed, but the medium-term bullishness for 2026 remains intact.
Okay. Institutional targets are great for the long term, but our listener is an active investor. They're looking at their portfolio today. They need to navigate February. Let's break this all down into actionable scenarios. What does the next month look like?
Based on the technicals and that on-chain data, we're looking at three pretty distinct paths.
Give me scenario one, the bullish breakout. What triggers it?
The trigger here is a weekly close above 99,500. We need to clear that short-term holder cost basis and decisively.
And if we get that close, what happens?
The coiled spring releases upward. We're looking at a fast move to between 110,000 and 125,000 in Q1. The drivers would be a renewal of ETF inflows. We'd need to see sustained days of over $200 million coming in, and that Bollinger compression just snapping.
Okay. Now give me the bad news. Scenario two, the bearish breakdown.
This happens if we lose that whale defense level, if we close a daily candle below 89,000.
That invalidates the smart money floor.
Right. If that breaks, the next target is the structural support at 84,000. And honestly, if 84,000 breaks, things could get ugly.
How early?
We're looking at a deeper correction, potentially down to 69,000. That would likely coincide with macro conditions worsening. Maybe tariffs heating up or interest rates not coming down as fast as expected. We'd also be watching for the death cross, the 50-day moving average crossing below the 200-day. It's a lagging indicator, but the algorithms trade off it. It would just accelerate the selling.
So 89,000 really is the line in the sand. And scenario three,
The grind, also known as the chop. We just stay range-bound between 90,000 and 96,000 for another month.
just bleeding theta and frustrating everyone. What causes that?
Indecision. The market is waiting for a catalyst. Maybe it's waiting for... The Federal Reserve rates are currently at 3.5% to 3.75%, but the market wants them lower. Or maybe it's waiting for regulatory clarity, like that Clarity Act that was mentioned in the Tiger Research Report. Until one of those shoes drops, we just go sideways.
So putting it all together, we are in a repair phase. The on-chain fundamentals, the low reserves, the whale accumulation, that shift to directional betting, those are all screaming bullish. But the technicals price being below the 200-day moving average are telling us to be cautious.
That's the perfect summary. It's a battle between bullish supply dynamics and bearish price momentum.
Before we wrap up, I want to leave the listener with something a little provocative. We saw this mentioned in a couple of the sources, specifically about that divergence between gold and Bitcoin, the quantum threat.
Yes, this is fascinating.
Yeah.
And and terrifying.
Some analysts are suggesting that Bitcoin's underperformance against gold might actually be the market starting to price in a quantum computing discount.
The idea is that a powerful enough quantum computer could, theoretically, crack Bitcoin's encryption, specifically the elliptic curve digital signature algorithm.
Now, developers say this is a very long-term risk. There are upgrades like quantum-resistant soft forks that can fix it.
They can, but markets hate uncertainty. Gold is an element. It doesn't have a quantum problem. Bitcoin is math, and math can be broken.
So the question for you, the listener, is this a real existential threat that justifies a discount? Or is it just the latest wall of worry that Bitcoin has to climb?
And if the history of Bitcoin tells us anything, it loves climbing a wall of worry. It thrives on doubt.
That it does. All right, keep your eyes on the charts this week. Watch 89,000 on the downside and 98,000 on the upside. Those are your lines in the sand.
And don't get shaken out by the chop.
Thanks for listening to this deep dive. We'll catch you in the next one.